It's hardly an environment really to be in equities right now. What are you telling your clients who might be losing faith?
Well, I mean, there's no doubt it's a challenging environment, and that's in fact what we just wrote about yesterday. There's three key factors that are really conspiring in a kind of poisonous cocktail that's hurting markets, and those, of course, are rising rates, worries about growth slowdown, particularly recession in the U.S., and zero COVID impact policy in China, and then on top of that, a strengthening dollar, which tends to be adverse for Asian equities. So it's no doubt it's challenging, and we're off to the worst start in Asian equities. In the entire history of the MX APJ index, this is the second worst start for January to May on record. So it's tough. I think the mitigating factors, if you can take a somewhat longer view, because the near term clearly is going to stay bumpy, we think. The mitigating factors, as you just mentioned, David, are that the index is down 30% from its highs last year. The forward PE multiples compressed from 18 times to 12 times, in fact, a little bit lower. China is trading at 10 times, a little bit less. We've seen nearly the same amount of foreign investor selling in Asia as we saw in the global financial crisis, and we don't think operating conditions are as bad as they were then. And you do get some positive seasonality kicking in later in the year. So our message really is it's going to be tough and bumpy in the near term, but we think there are clear reasons to expect better returns on a 12-month view.
Right. And before we look at some of those, I guess, what you're calling alpha themes amid challenged beta, I just want to understand, at about 12 and a half times earnings right now, Mo, are you changing the way you guys look at how your methodology surrounding valuing stocks? In other words, I'm trying to get to is how are you guys accounting for rising rates, rapidly rising rates?
Sure. So we have a top-down PE model, which is one of the valuation tools we use. We've got a pretty wide suite of ways we look at the market, but one of them has served us quite well, really, for the past decade or so, has been a top-down PE model, which incorporates a lot of the different macro factors that impact markets. And those would include things like growth in Asia, growth globally, U.S. 10-year rates, commodity prices, the level of valuation of the S&P, because investors look at markets cross-sectionally globally, and the U.S. obviously is the dominant market, so you have to take that into account. And we also account for fund flows. So we think we've got a way of describing how markets should trade given the macro backdrop that they find themselves in. And what that's telling us right now is that on our expected conditions over the next year, that something around 13 times should be a fair and appropriate valuation for Asian markets. We actually take a bit of a haircut to that to account for geopolitical risk. We've done some work on how the equity risk premium tends to change when you've got heightened geopolitical risk environments. So with an additional haircut, then we come up with our 12.7 times forward multiple. Now, there's nothing super magical about that, but I think it's a pretty good approximation for where markets should find their central tendency of how they should trade.
Right, and on the benchmark, 630 is the target. That's about, what, 17%? 20% upside from here?
That's about 17% up from current levels. And I think, that may sound like, wow, you guys are super bullish. But if you disaggregate that, it really breaks down to two things. One, we still think we've got about 10% forward EPS growth for the region as we go into 2023. And as we go through time, that's what markets will be keying off of. So that's number one. And number two, as I mentioned, we're trading about 12 times earnings now. And if we think 12.7 is a fair target, you can get a little bit of multiple recovery, I think, especially in China. And if you combine those two, then you get sort of mid to high teens potential returns.
I want to ask you about your call on Taiwan and alongside Korea, which I understand you're still overweight. Are you still overweight Korea? Anyway, you've lowered Taiwan. And the reason
Korea.
I put... Okay, understood. Well, you've lowered Taiwan. The reason I put those two in the same basket, we've seen outflows from both those markets. Why do you have differing views, basically, on those two markets?
Yeah, it's a great question. I mean, the larger point to start with is that North Asia tends to be more sensitive to the sort of adverse headwinds that are blowing from a global perspective. So they tend to be more trade-oriented, more globally exposed. Taiwan obviously has a lot of linkages with China, as does Korea. So they're sensitive to the slowdown in China there. We've got some analysis we've recently done on that in our piece. I'd say the difference here is that Korea's valuations have compressed more than Taiwan's. I realize you have to account for the fact that they tend to have different trading levels, but even if you look at them relative to their ranges, Korea's a little bit more sold down. And then there's an additional issue which we've written about, which is there is this upside potential for Korea if it's again included in the MSCI list of potential upgrade to developed market status. And we've quantified that that could actually be a meaningful kind of Korea-specific upside potential. So at this point, we think there might be a slightly better tilt towards Korea. But both of them, I think, in the long run will look attractive. We just need to get through this global growth concern and also see a more favorable turn in the tech cycle, which both markets and economies are sensitive to.
Tim, we're almost right on cue. The Taiwan Central Bank just out right now talking about inflation will remain or will be over 2% in the second half of this year. Talk about then these alpha themes. Commodity super cycle, and you like metals and mining.
Yeah, that's correct. So we have a very, very strong view that collectively in our macro research unit, we've been espousing, which really embraces the idea that there's a commodity supercycle going on. We don't have time to go into all the logic for that now, but it's basically predicated on very significant and longstanding supply constraint because of underinvestment, particularly in energy, but also other areas, an expectation that we'll have some structural demand changes going on. And we put those together, it says to us that we think that energy prices are going to be higher for a longer period of time, and also base metals as well. So we've been overweight energy. We've upgraded our view on metals and mining, thinking that the shorter term sell down we've seen really caused by some concerns about growth in China, which of course is a big consumer of those, gives us an opportunity to re-enter at somewhat better prices. So we think one of the places that we feel most comfortable about is this theme of a commodity supercycle, and especially because the stocks have not traded the way that the spot commodities have done. There's still sort of a lag between what spot has done versus the stock. So there's some catch-up potential in equities in our view.